Most people think their money is safe just because it's sitting in a bank, but that assumption has quietly destroyed more wealth than bad investments ever did. The truth is, the system isn't designed to protect all of your cash, only a portion of it. And very few people actually understand where that line is drawn. Stanley Druckenmiller has long warned that risk doesn't come from what you see, but from what you assume can't happen. And right now, millions of Americans are unknowingly crossing a critical threshold, the 250,000 bank rule. That could determine whether their savings remain intact or become part of a much larger problem. The 250,000 limit is far more than just a number. It's the line that separates guaranteed security from uncertain risk, and most Americans have no idea where their money stands relative to it. When people deposit money into a bank, there's an almost instinctive trust that their cash is safe, that it's immune to the fluctuations of the economy, that it's untouchable. But the reality is far different. The Federal Deposit Insurance Corporation insures deposits only up to $250,000 per depositor per bank, which means anything beyond that amount is not protected if the bank fails. Most people glance at their bank statements and assume the total sums listed there are fully covered. But the truth is that the moment you exceed that threshold, you enter a zone of financial vulnerability that can wipe out decades of savings in an instant. What makes this limit particularly insidious is how subtly it hides in plain sight. Bank customers rarely think in terms of insurance limits. They think in terms of balances and interest rates. They are lulled into a false sense of security because the institutions themselves rarely highlight the risks. Advertising always emphasizes stability, convenience, and growth, painting a picture where deposits feel like a fortress against uncertainty. Meanwhile, the fine print quietly reminds you that thousands could be at the mercy of market forces, bank mismanagement, or sudden economic shocks. This number isn't arbitrary. It was set decades ago after a financial crisis to provide reassurance, but in today's hyper-connected banking system, where money moves instantly across networks and liquidity can evaporate overnight, that old rule carries a weight of urgency few fully grasp. Understanding the 250,000 cap requires imagining scenarios that most people don't want to consider. Picture a mid-sized regional bank facing a sudden liquidity crunch. A run on deposits begins, fueled not by poor planning but by panic. Customers start withdrawing funds as fast as possible, and the bank struggles to meet demand. Those with deposits under the 250,000 line are fully protected, but anyone with larger balances finds themselves in uncharted territory. Insurance may not cover them, and their savings could become inaccessible for months, if not longer. In a modern economy where speed is everything, a bank failure isn't just a slow collapse, it's a rapid cascade of events that can leave you powerless if you haven't prepared. Another aspect to consider is that many Americans unknowingly concentrate their wealth in a single bank. They maintain multiple accounts for convenience, but often these are all within the same institution. Checking, savings, and certificates of deposit might feel like separate holdings, but the FDIC treats them as one when calculating insurance coverage. That means someone with a checking account of $100 and a savings account of $150 and a CD of $75,000 in the same bank is effectively over the insured limit by $75,000, even though it may not feel that way when reviewing monthly statements. The way money is distributed across account types can make a critical difference, and the average depositor rarely thinks about that. It's a subtle trap disguised by familiarity and convenience, and it catches people when they least expect it. Interest rates, too, can lure people into danger. In a low-rate environment, there's an incentive to consolidate funds to earn even marginally better returns, but that often means pushing deposits beyond the 250,000 ceiling. A seemingly smart financial move, maximizing interest income, can inadvertently place a large portion of your wealth in the uninsured zone. It's a paradox. The pursuit of security through higher yield can actually increase exposure. Druckenmiller himself has repeatedly emphasized that risk isn't always obvious, that the most dangerous hazards are often invisible until they materialize. The limit is not just about numbers, it's about behavioral patterns and assumptions. People trust what they see in statements and statements of balance, but the unseen rules governing insurance can turn trust into vulnerability. Compounding the issue is the modern pace of financial events. Digital banking and instant transfers have made withdrawals nearly frictionless. In the past, a bank run required physical presence, slowing down the process and giving regulators more time to intervene. Today, millions of dollars can vanish from accounts in a matter of minutes, leaving the FDIC scrambling to assess exposure. In this context, the 250,000 limit becomes even more critical because it defines who is immediately safe and who is potentially at risk. It's a threshold that can dictate whether one wakes up to an intact account or a temporarily frozen or partially lost balance. The speed of modern finance amplifies the consequences of ignoring this number, turning a rule that once seemed academic into a matter of survival. What makes it even more urgent is the psychological comfort many Americans derive from assuming their deposits are inherently safe. A trust in the banking system is deeply ingrained, almost instinctual, passed down through generations who equated banks with stability. But that trust, while comforting, is not a substitute for knowledge. Knowing the 250,000 limit isn't just about understanding insurance. It's about recognizing that the institutions you depend on operate in a world of risk, leverage, and human error. It's about realizing that a number that seems arbitrary on paper has real-world consequences that could affect the trajectory of your financial life in ways most people would rather not imagine. Understanding the 250,000 rule is not complicated, but it requires shifting perspective from convenience to strategy. It demands recognizing the invisible lines that determine safety and vulnerability. When people grasp that line, they begin to see the choices in a new light, which accounts to open, how to distribute funds, when to consider multiple institutions, and how to structure deposits to stay fully insured. Awareness of this single number can completely reshape financial behavior, turning passive trust into active security. It's more than a guideline. It's a critical insight into the mechanics of safety in a system that rarely gives explicit warnings. The thrill, the urgency, and the high stakes all come from the realization that, despite appearances, a simple threshold can mean the difference between preserved wealth and sudden exposure. Any amount above that limit is no longer protected by the FDIC, which immediately turns what feels like security into a zone of uncertainty where the rules change without warning. Most Americans assume that banks are inherently safe, that deposits are untouchable, and that government guarantees extend to any amount they choose to save. This assumption is dangerously misleading. The moment your balance exceeds 250,000 at a single institution, the excess funds enter a gray area. Technically your money, yes, but practically exposed to the bank's fortunes, market swings, and operational errors. The distinction is subtle but critical, and ignoring it can transform a well-intentioned savings plan into a precarious gamble that carries more risk than most people are willing to acknowledge. The psychological impact of knowing that only a portion of your deposits is insured cannot be overstated. People are wired to feel safe when money sits in a bank account, but the truth is that financial security is conditional, not absolute. The FDIC's limit is a firm boundary, and anything beyond that line becomes susceptible to factors entirely outside the depositor's control. A bank's solvency, liquidity, and exposure to risky investments suddenly matter in ways they didn't seem to when balances were comfortably below the insured threshold. The money above 250,000 is still yours, but if a bank fails, you may be forced to wait, negotiate, or even lose a portion of it entirely. The sense of control evaporates the moment you cross that invisible line. Historical examples demonstrate how real and immediate this danger can be. Bank failures are not relics of the past. They happen with surprising frequency, even in highly regulated economies. Institutions that seemed rock solid yesterday can face sudden crises due to poor management, speculative investments, or macroeconomic shocks. In these scenarios, depositors with balances exceeding the insured amount are the first to feel the consequences. While smaller depositors can rely on FD insurance for full reimbursement, those with larger sums may receive only a fraction of their money, if at all. until the bank's remaining assets are liquidated. The stakes are high, and the margin for error is thin, making awareness and proactive planning absolutely essential. The risk intensifies when you consider the modern banking environment, where digital platforms allow for nearly instantaneous transfers. Money can flow in and out of accounts in seconds, creating volatility that banks must constantly manage. If an institution miscalculates liquidity needs, even temporarily, depositors holding more than the insured limit could find their funds temporarily frozen or tied up in legal and administrative procedures. What feels like a simple, everyday deposit suddenly becomes part of a complex system with rules that are not immediately visible to the casual account holder. The combination of high balances, instantaneous banking, and a banking system that operates at the speed of digital networks makes exceeding $250,000 a high-stakes decision whether people realize it or not. Many depositors fail to account for how interest-bearing accounts, CDs, and other financial products aggregate when calculating insurance coverage. The FDIC doesn't treat different accounts as separate if they are under the same ownership at the same bank. A checking account, a savings account, a money market account, and multiple CDs may all seem distinct, but for insurance purposes they are combined. That means that it is surprisingly easy to unintentionally exceed the $250,000 threshold, leaving large sums uninsured. People think they are diversifying within the same institution, but the rules of insurance aggregation make these efforts ineffective. This hidden complexity adds another layer of urgency to understanding what portion of your deposits is actually protected. The allure of maximizing convenience and return drives people into dangerous territory without realizing it. Consolidating funds in a single institution can seem logical for ease of management and slightly higher yields, but the hidden cost is exposure. The pursuit of marginal benefits can quietly push deposits over the insured limit, placing the excess at risk. Druckenmiller consistently emphasizes that the most significant threats are often invisible, hidden behind a veneer of normalcy and trust. The risk isn't the institution itself, it's the assumptions that individuals make about what is safe. Ignorance of the limit, or blind faith that "it won't happen to me," can transform a small convenience into a major vulnerability. This is compounded by the fact that many Americans do not actively manage their deposits. Auto payments, direct deposits, and recurring transfers can accumulate balances beyond insured limits without anyone noticing. The automation that makes modern banking convenient also makes it dangerous. While it is easy to trust that the numbers on your app or statement are fully safe, the reality is that the unseen $50,000, $100,000, or $500,000 above the insured line is living on borrowed time. The illusion of security is powerful, but when a crisis hits, the illusion collapses instantly, leaving even the most diligent savers scrambling to protect what they thought was untouchable. Another layer of risk lies in assuming that the government or the banking system will always backstop deposits. People hear about bailouts, rescue packages, and emergency interventions and internalize a false sense of guarantee. But those measures are neither predictable nor comprehensive. A balance above $250,000 may survive intact, but it may not. It depends on timing, regulatory response, and the specific circumstances of the institution's failure. Trusting that external safety nets will cover what exceeds the insured limit is a gamble few are aware they are making. That gap between perception and reality is where real risk hides, and it's the reason understanding the $250,000 limit is not just a technical detail, but a critical element of financial strategy awareness and survival. Bank failures happen faster today due to digital withdrawals, a reality that transforms risk into immediate danger for anyone with deposits exceeding the insured $250,000 limit. In the past, a bank run required physical presence, a line at the teller window, and hours, sometimes days, of delay, giving regulators and institutions time to respond. Today, a wave of panic can sweep through an institution's customer base in minutes, triggered by news alerts, social media, or even rumors. The speed at which funds can disappear from accounts has fundamentally changed the landscape of banking risk. A depositor who thought their money was safe may suddenly find themselves caught in a digital storm, where seconds determine whether funds remain accessible or become entangled in a financial crisis beyond their control. The modern banking system's reliance on real-time technology is both a convenience and a hazard. Instant transfers, online payments, and mobile banking apps give depositors unprecedented access to their funds, but they also allow mass withdrawals to occur at a pace banks are ill-prepared to handle. When panic sets in, the cumulative effect of thousands or millions of custom moving money simultaneously can overwhelm liquidity, exposing any deposits above limit to potential loss. The FDIC insurance covers the first $250,000 per depositor per bank, but the rest becomes dependent on the institution's remaining assets and the speed with which regulators can intervene. In such a scenario, having a balance that exceeds the insured limit is not just a minor risk, it's a vulnerability that can escalate within hours. What amplifies this risk is the way fear spreads in the digital age. A single report of a bank experiencing trouble can cascade across multiple platforms, prompting withdrawals even from customers who have no direct exposure to the initial issue. Social media amplifies perception, and perception drives behavior. Depositors with balances above the insured limit may find themselves suddenly competing with hundreds of thousands of others to secure their money. Even if the institution is fundamentally solvent, the speed and scale of withdrawals can create a temporary crisis that leaves excess deposits frozen or inaccessible. In the modern context, the 250,000 rule is not just a static guideline, it is a threshold of immediate relevance, a line between guaranteed access and potential chaos. This environment also challenges traditional assumptions about diversification within a single bank. People often think that splitting funds across multiple accounts, checking, savings, and CDs offers protection, but for FDIC purposes, those accounts are aggregated under one depositor at one institution. What feels like diversification is frequently an illusion, and when withdrawals spike, all of the excess beyond the insured limit is at risk simultaneously. It's a subtle trap because the deposits themselves appear secure on a day-to-day basis, lulling account holders into a false sense of safety. The danger is invisible until the system is stressed, and by then, the consequences are immediate and potentially severe. The speed of modern bank failures also highlights the importance of proactive planning. Historically, regulators had time to intervene, provide emergency liquidity, or orchestrate controlled acquisitions. Today, technological efficiency compresses the timeline, leaving depositors to act quickly or risk being caught unprepared. Individuals who have carefully structured their deposits to stay below the 250,000 insured threshold are protected, but those who assume that larger sums are automatically safe can experience panic and loss. It's a high-stakes environment where knowledge and preparation directly translate into security, and ignorance can result in exposure that feels sudden, even if it was avoidable. Understanding this risk requires thinking beyond simple account balances. It demands an awareness of how financial flows operate in real time and how quickly trust can be tested in a hyper-connected world. People must consider not just the size of their deposits, but also the pace at which money can leave an institution, the potential for systemic panic, and the mechanics of FDIC insurance. It is no longer sufficient to assume that the institution itself guarantees safety. The reality is that the combination of digital speed, aggregated accounts, and market perception can create vulnerabilities that were virtually impossible to encounter in the era of manual banking. The modern banking environment also adds complexity to strategies designed to protect wealth. For example, spreading funds across multiple banks seems like an obvious safeguard, but logistical challenges, delayed transfers, and account setup processes can limit how quickly one can react to a sudden crisis. Even sophisticated investors who understand the 250,000 rule may struggle to move large sums fast enough to avoid temporary exposure. The pace at which digital withdrawals can accelerate a bank's liquidity problems means that the difference between protected and at-risk deposits can literally be measured in minutes. In this context, the 250 threshold becomes not just a guideline, but a critical line that separates guaranteed access from a rapidly escalating, high-stress scenario. The immediacy of risk forces a revaluation of how people think about banking safety. Trust in institutions, while important, is insufficient in a world where technology allows mass action to happen instantly. Those with deposits above the insured limit are effectively placing part of their wealth in a zone where speed, perception, and the unseen mechanics of banking determine outcomes. The combination of digital efficiency and concentrated deposits magnifies risk, making awareness, strategic distribution of funds, and careful monitoring essential for anyone who wants to truly safeguard their money. It's a thrilling and sobering realization that the line between security and exposure is no longer theoretical. It can shift in real time, and understanding that line is the key to staying ahead of the unexpected. Spreading cash across multiple banks can reduce exposure, but the strategy requires far more thought and precision than most people realize. It sounds simple on the surface. Open accounts at different institutions, keep each under their 50,000 FDIC insurance limit, and suddenly your money is fully protected. But in practice, it's a high-stakes game of logistics, timing, and understanding the subtle rules that govern deposit insurance. Many Americans think that merely having accounts at different banks automatically shields them, but without careful planning, it's easy to leave gaps, overlap coverage, or unintentionally place significant sums in a vulnerable position. The thrill and the risk lies in navigating this system deliberately, turning what seems like mundane financial housekeeping into a tactical exercise in wealth preservation. The first challenge in spreading funds is identifying institutions that offer not just convenience, but reliability. It's not enough to choose banks based on proximity, mobile app design, or promotional interest rates. One must consider financial health, history of stability, and exposure to risk. Some regional banks may seem safe, yet their balance sheets are more susceptible to sudden liquidity pressures. Diversifying across multiple banks reduces exposure to any single institution's failure, but selecting the right mix requires a level of research and foresight most people avoid. This is where many fail to see the danger. They assume all banks are equal, that FDIC insurance alone is sufficient, without recognizing that the stability of the institution affects how quickly and smoothly excess funds can be recovered if trouble arises. Once the institutions are chosen, the next layer of complexity is determining how to allocate deposits effectively. It's not just a matter of keeping each account below $250,000. The FDIC calculates insurance coverage based on ownership categories and account types, which adds nuance to what seems like a simple cap. Individual accounts, joint accounts, retirement accounts, and trust accounts are treated differently, and careful structuring can maximize coverage. A checking account, a savings account, and a CD at the same bank may be aggregated into a single insured total, unless the ownership type differs. Savvy depositors who understand rules can protect far more than $250,000 per bank, but ignorance of these details can leave even diversified funds partially exposed. It's a game where knowledge literally equates to security, and missing a single detail can turn a protective strategy into a weak defense. The pace of modern finance further intensifies the stakes. Money can be moved between banks in real time, but speed also matters when a crisis begins. During sudden bank stress, funds above the insured limit may become temporarily inaccessible while regulators assess the institution's solvency and liquidation options. Those who have already diversified across multiple banks minimize their risk, but timing still plays a critical role. The faster money is allocated correctly, the more secure it becomes. The difference between a well-structured network of accounts and a haphazard one can mean tens or hundreds of thousands of dollars preserved or temporarily frozen, inaccessible, and at risk. It's a subtle thrill, a hidden adrenaline that comes from knowing the difference between strategic action and passive reliance. Behavioral factors also play a role in effective cash distribution. Humans naturally seek convenience, often keeping accounts concentrated for ease of management. Auto-pay, direct deposits, and recurring transfers encourage consolidation, which works against a diversification strategy. Breaking old habits, monitoring balances, and actively managing multiple institutions may feel cumbersome, but it's precisely this effort that separates those whose funds remain fully insured from those whose excess deposits are exposed. The system rewards diligence, attention, and proactive planning, and it punishes complacency. In a world where digital withdrawals and instant communication amplify panic, these behavioral choices become critical determinants of financial security. Another critical consideration is monitoring ongoing exposure. Diversification isn't a one-time task. Balances fluctuate, accounts mature, and deposits grow through interest and dividends. Without regular oversight, what was once a fully insured network of accounts can quickly drift into the unsafe zone. Savvy depositors understand that spreading cash is not a set-it-and-forget-it solution. It's an ongoing strategy that requires constant vigilance. Alerts, regular reviews, and periodic redistribution become tools of protection, ensuring that the 250,000 threshold is respected across all institutions, even as personal finances evolve. The thrill is in the mastery of this dynamic system, where knowledge and discipline continue to translate into safety. Strategically spreading cash also offers psychological advantages. Knowing that each dollar is deliberately placed within insured limits provides peace of mind, a sense of control over circumstances that are otherwise unpredictable. The act of structuring deposits across multiple banks transforms fear into strategy. It's a proactive stance that contrasts sharply with passive trust, which assumes the banking system will safeguard all funds regardless of limits. The insight is simple, but profound risk is not eliminated, but it can be managed, mitigated, and in some cases entirely avoided. Those who master this approach gain not only financial security but also a mental edge, a clarity that comes from confronting risk head-on rather than hoping it never materializes. Finally, spreading cash effectively is a discipline that blends calculation with foresight. It requires understanding the interplay of account types, insurance rules, institutional stability, and the speed of modern banking. It demands attention to detail, ongoing vigilance, and a willingness to act decisively when balances grow or circumstances change. For many, this level of engagement may feel excessive, but for those who understand the stakes, the consequences of exceeding the insured limit in a volatile, digital banking environment, it is the difference between vulnerability and control. Each decision, each account, each allocation becomes a tactical move in a larger game of safeguarding wealth, and the margin for error is precise and unforgiving. Not all accounts are structured to maximize insurance coverage, and that oversight is where many Americans unknowingly expose themselves to risk. On paper, it seems straight deposits under $250,000 and the FDIC guarantees them, but in practice, the rules governing coverage are far more nuanced, and failing to account for these subtleties can mean the difference between full protection and partial exposure. Checking, savings, money market accounts, CDs, and retirement accounts are not all treated the same under federal insurance rules, and many people assume that simply holding different types of accounts at the same bank automatically increases coverage. That assumption is dangerously misleading, because the FD aggregates certain accounts when calculating insurance, meaning deposits that appear distinct may actually count toward a single total limit. Understanding how each account is categorized is crucial to ensuring that all your money is truly protected. Joint accounts offer one example of how account structure can impact coverage. A joint account is treated differently than individual accounts, and in many cases, the FDI provides separate coverage per co-owner. While this might seem like a way to double or even triple protection, the rules are precise. Each co-owner is insured up to $250,000, and all joint accounts are aggregated together for each owner. This nuance can be easily overlooked. For instance, if a couple holds multiple joint accounts across the same bank, they might assume that distributing balances across accounts increases protection, but in reality, the FDIC aggregates them for insurance purposes. Misunderstanding this aggregation could leave significant sums of money unprotected, creating exposure that feels invisible until a bank failure occurs. The thrill and danger lie in these hidden layers. What seems secure can be surprisingly fragile. Retirement accounts introduce another layer of complexity. Certain retirement accounts, such as IRAs, are insured separately from standard deposit accounts, offering another avenue to extend protection beyond $250,000. However, not all retirement accounts qualify for this separate coverage, and the details depend on the type of account, the institution, and the ownership structure. People often assume that simply labeling an account as retirement automatically grants full insurance, but the FDIC's rules are more precise than that. Understanding which accounts qualify for separate insurance and how they interact with existing deposits is essential for anyone looking to protect substantial wealth. The thrill here comes from mastering these rules. What appears complex can be leveraged strategically, but ignorance transforms opportunity into risk. Trust accounts further complicate matters. A revocable trust account can provide insurance coverage per unique beneficiary, meaning that a single account could be insured for far more than $250,000 depending on how it is structured. However, the details are precise, and errors in naming beneficiaries, structuring accounts, or misunderstanding the coverage can negate these benefits. Many depositors assume that adding beneficiaries or labeling an account as a trust automatically increases insurance, but in practice, the rules are strict and require careful adherence. Failing to account for these nuances leaves substantial sums uninsured, a hidden vulnerability that only becomes apparent in times of institutional stress. The thrill lies in recognizing how these complex structures can both protect and imperil wealth, depending on how well the rules are understood and applied. Another critical consideration is how interest accrual and account growth affect coverage. Deposits are not static, they grow over time, whether through interest, dividends, or transfers. A deposit that starts below the $250,000 limit may eventually exceed it, unintentionally placing in the uninsured zone. Savvy account holders must monitor balances, anticipate growth, and redistribute funds to maintain full coverage. The dynamic nature of money, combined with the rigid $250,000 threshold, creates a scenario where continuous attention is required. Many people assume that once accounts are set up, they remain safe indefinitely, but in reality, vigilance is necessary to ensure that growth does not inadvertently expose funds to risk. This interplay of strategy, timing, and account structure adds both thrill and tension to wealth management. Compounding the challenge is the fact that not all banks communicate the nuances of FDIC coverage effectively. Statements, online dashboards, and customer service representatives often emphasize convenience, balances, and interest earned, but rarely provide clear guidance on insurance limits, account aggregation, or exceptions. Depositors are left to navigate a complex system with incomplete information, relying on assumptions that can prove costly. Awareness of these structural subtleties becomes not just a technical detail, but a form of financial self-defense. Those who study and understand the rules gain an advantage, while those who assume coverage is automatic risk exposure that could be catastrophic in the event of a bank failure. The combination of multiple account types, ownership structures, and growth dynamics makes account structuring a sophisticated exercise in risk management. Simply opening accounts without consideration of these factors is akin to building a fortress with weak points in the walls. Everything looks secure until the pressure comes. Strategic account structuring allows depositors to maximize protection legally and effectively, transforming the seemingly mundane tactical accounts into a tactical game. It's a thrilling challenge that rewards attention to detail, foresight, and consistent monitoring. Those who master it gain both financial security and a psychological edge, knowing that they have minimized exposure in a system that often hides risk in plain sight. At the heart of this challenge is the realization that money management is no longer just about balances and interest rates. It's about understanding the hidden architecture of protection, the precise rules that determine whether each dollar is safe or vulnerable. Those who structure their accounts intelligently gain not just coverage but control, while those who rely on assumptions remain exposed. The stakes are high because a single misstep, misunderstanding a rule, overlooking an account, or failing to anticipate growth can suddenly turn a seemingly safe sum into a portion that is entirely unprotected. The thrill and the danger come from the intersection of knowledge, strategy, and vigilance in navigating a system where the difference between safety and risk is measured in account structures, ownership categories, and carefully applied rules. Assuming the government will fully backstop deposits is a dangerous mindset, one that lulls countless Americans into a false sense of security while their money quietly becomes exposed. Stories of government bailouts, emergency interventions, and the FDIC's reputation for reliability create a psychological safety net, convincing people that the system will always step in to protect their funds, no matter the circumstances. But relying on this assumption is risky because these mechanisms are neither guaranteed nor instantaneous. The FDIC covers deposits only up to $250,000 per depositor per bank, and anything beyond that is subject to the realities of the institution's financial health and the pace at which regulators can act. Believing otherwise is a subtle form of complacency, a dangerous faith in systems that can falter under stress. The thrill and the danger lies in understanding just how conditional these safety nets are. While small depositors are fully insured, those with larger balances must confront the uncomfortable truth that government protection does not extend automatically beyond the statutory limit. In the event of a bank failure, the excess funds may become inaccessible for days, weeks, or even months, depending on how quickly the institution's remaining assets can be liquidated. The speed of modern banking compounds this risk. Digital withdrawals, instant transfers, and interconnected financial networks mean that funds can move faster than regulators can react, creating scenarios where the uninsured portion of deposits is effectively in limbo. Trusting that the government will act as a universal safety net in these moments is not only optimistic, it's dangerous. History demonstrates that even in developed financial systems, large-scale interventions are rare and often selective. Bailouts are typically aiming institutions considered too big to fail, leaving smaller banks' depositors to rely on standard FDIC procedures. This selective approach to intervention is not a blanket guarantee. Individuals with deposits above a $250,000 at smaller or mid-sized banks are especially vulnerable, as their uninsured funds depend entirely on the bank's asset recovery process. Waiting for a government rescue is not a strategy, it's a gamble. The difference between a depositor who understands these limits and one who assumes absolute safety can be the difference between preserved wealth and sudden exposure. The digital age amplifies these stakes further. Instant communication and real-time financial networks can turn rumors into panic at unprecedented speeds. A single news report of financial stress at a bank can trigger a cascade of withdrawals, putting pressure on liquidity and potentially freezing uninsured deposits even before any government action is taken. The 250,000 rule is no longer an abstract regulatory number. It's a critical line that separates guaranteed access from exposure to market realities, operational decisions, and the timing of regulatory interventions. Those who assume that the government will automatically cover anything above this threshold are unknowingly betting against speed, perception, and the mechanics of modern finance. This mindset also creates behavioral traps. Believing in unconditional backstops encourages concentration of funds in one institution, reliance on a single account type, and passive management of balances. People may think won't happen to me, or assume that the government will handle any crisis, reducing their incentive to actively diversify and monitor accounts. This false sense of security can be fatal in moments of stress. The FDIC's rules are designed to protect the majority of depositors under normal circumstances, but crises exploit overconfidence, and the uninsured portion of deposits becomes highly vulnerable precisely because people assume intervention is automatic. Ignorance, combined with misplaced trust, creates a high-risk scenario where the consequences are immediate and severe. The psychological aspect of assuming full government protection is equally significant. It's comforting to believe that money in a bank is untouchable, but comfort often masks exposure. The thrill in the context of financial risk comes from understanding that the safety people take for granted is conditional, and that real control requires deliberate action. Those who internalize the limits of insurance begin to see wealth management differently. They no longer treat deposits as passive holdings, but as strategic assets that require attention, planning, and sometimes rapid action. This shift in mindset is essential for anyone with significant savings, because assuming safety without verification is a vulnerability in itself. Strategic preparation is the antidote to this dangerous mindset. Those who understand that the government's backstop has limits take proactive steps, spreading deposits across multiple institutions, structuring accounts to maximize insurance, monitoring balances regularly, and considering timing for larger transfers or investments. Every decision becomes a calculated maneuver, not a passive reliance on perceived safety. The 250,000 rule transforms from a simple regulation into a tactical threshold, a line that defines guaranteed security versus exposure. Knowledge replaces faith, and control replaces complacency, creating both a psychological edge and a practical shield against unforeseen financial shocks. Furthermore, understanding the limitations of government intervention changes how people respond during crisis. Instead of panicking blindly or assuming recovery will be automatic, informed depositors can act quickly and decisively. They recognize that insured deposits are secure, while excess funds require careful management, including potential temporary liquidity adjustments or redistribution to fully insured accounts. The difference between those who assume full backstops and those who plan strategically is stark. One group faces reactive uncertainty, while the other maintains proactive control. The tension between these approaches highlights both the thrill and the peril inherent in modern banking. Speed, information, and preparation dictate outcomes in ways that were unimaginable just a few decades ago.